A staggering 84% of retirees mishandle their RMDs, and most of them don't even realize until it's too late. I had a lady call in last week. Her husband passed away, and she made a required minimum distribution mistake that's going to cost her $30,000 of extra taxes. I'm going to show you what mistake she made and what you can do to avoid it. RMDs are not just another retirement rule. They dictate how much you must withdraw from your IRA account, and the IRS is very strict about it. If you miscalculate or ignore them, you run the risk of unnecessary taxes, penalties, and missed opportunities that could cost you some of your retirement income. Now, you need to understand what an RMDs are and what your options are so you can make the best decision that's right for you. So let's break down what an RMD is. RMD stands for Required Minimum Distribution. It's the minimum amount the IRS mandates you withdraw annually from certain retirement accounts, like 401k accounts, traditional IRA accounts, once you reach a certain age. And now the age you have to reach is 73 years old or older. Now, why do you think the IRS wants you to take money out of your 401k or IRA? You're right, taxes. They want to tax your money. And when you take that money out, it becomes a taxable event. Now, the penalties for missing your RMDs can be quite expensive. They can be up to 25% if you make a mistake there. So you really want to make sure that you do not miss your RMDs. RMDs are calculated by taking your account balance at December 31st of the previous year and dividing it by the life expectancy factor that the IRS provides. Take a look at this chart and you can see that the percentage that you must withdraw from your IRA goes up as you age. The number one mistake I see most retirees make is only taking the minimum amount of their IRA accounts without considering the overall bigger tax picture. They assume that if they take the minimum amount that it's going to be better. But what they're actually going to be doing is hoarding assets, leaving a lot of life on the table. Now, we did a video previously on the number one fear for retirees is running out of money. But what actually happens is that they have too much money later in life, and they miss out on a lot of things they could do during their 60s and 70s. Another problem that they have, if they only take the minimum amount from their IRA accounts, is that they're deferring their tax bill down the road. So they're in a lower tax bracket today as they're in their early retirement years, but because they kick the can down the road, it's going to force bigger and bigger withdrawals in those IRA accounts later. And that's going to kick them up into higher and higher tax brackets, increasing their lifetime taxable income. And what this also does is increases the taxes on Social Security, increases the taxes on Medicare. So here's an example. Let's imagine two retirees, each with $1 million in their IRA accounts. One withdraws strategically in their 60s, managing their tax brackets until their required minimum distributions force them to take larger withdrawals at age 73. The second retiree ends up paying a significantly more taxes over the course of their lifetime because they may be in a very, very low tax bracket from 60 to 73, but because they didn't take out any money in their IRA accounts, their RMDs at age 73 and on are going to be much, much higher, pushing them from a very low tax bracket to a potentially a very high tax bracket later. So you almost want to think about it like this. Let's suppose, for instance, you ever had to shake up a can of Coca-Cola. You kind of don't want to pop it off immediately. It's going to go everywhere. You want to let it out just a little bit at a time. And that's the same thing you want to do when you're taking money out of your IRA accounts. If you're in lower brackets, start taking a little bit of money out. Maybe you take that money out and spend it on vacations or your lifestyle, or you can do Roth conversions. So a general rule of thumb is if you're in the 22 to 24% brackets or under, maybe take it from the IRA accounts. If you're over that, then you may want to consider deferring those withdrawals. Lesson 2 is a smarter way to manage your RMDs. So obviously blindly taking from the IRA accounts isn't the right thing to do. Nor is it good to delay forever and wait for those RMDs to kill you. It's better to be proactive with withdrawals and be mindful of the tax brackets you're in. So how do you do it? Start with withdrawals earlier. Take smaller, controlled amounts and know your tax brackets as you're withdrawing money from your pre-tax IRAs. Now you can do that by living off that income or converting money to your Roth IRA as what's called a Roth conversion. Another thing you can utilize before your required minimum distribution age is qualified charitable distributions. And what that is that if you give money to charity, if you're age 70 and a half, you can give money directly to charity from your IRA account and pay zero taxes. That's generally better than taking the money out, paying taxes, and giving it to a charity, because you may not qualify for itemized deductions. But even if you did, you wouldn't get 100% deduction. So when you're smart about your IRA withdrawals and mindful about the tax bracket you're in, what that does is reduce your overall lifetime taxes. Even with smart RMD planning, there's one more critical thing that you need to consider that can make or break your strategy. And that is the impact of RMDs on your legacy and estate plan. Required minimum distributions aren't just about you, it's also about what you leave behind. If you leave money in a traditional IRA account, your children are going to be forced to take money out of those accounts as well. And depending on where they are in their financial life, they may be in very high tax brackets and be forced themselves into a higher and higher bracket. Now, if they inherited a Roth IRA, they would get tax-free income. So what you really want to think about is not only your own tax brackets, but also your children's tax brackets later in life. So for example, if you're in a 10 to 12 to 22% bracket and your children are doing really well in life and are in a 32, 36% bracket, it may make sense for you to convert more money to a Roth IRA rather than leave it in a traditional IRA account. And when you do this, you're passing your assets on tax-free. And the rule is they better love you better for it. So the lesson is be strategic about your IRA withdrawals. Understand what tax bracket you're in. Plan accordingly. If you give to charity and you're over 70 and a half, consider qualified charitable distributions. Also, as we repeatedly said, Roth conversions could be an option if you're in a lower tax brackets prior to age 73. Also consider your legacy and what tax brackets your children are in and what types of accounts you're leaving to them. If you're able to do all of these things, you should be able to lower your lifetime taxes and your children should love you more. Now that you know the mistakes retirees make according to the required minimum distributions, there are many mistakes retirees make on their 401k accounts. Check out what they are in this next video.